Financial crises rarely begin with panic. They begin with paperwork, long before markets fall, before headlines turn urgent, before the public feels anything at all. Something quieter happens. Rules change. Definitions are adjusted. Requirements are softened or tightened. What once seemed stable is reclassified, deferred, or temporarily suspended. These changes are rarely framed as warnings. They are presented as technical upgrades, efficiency improvements, or temporary measures designed to maintain stability. Yet when viewed through history, a pattern becomes clear. Major banking and financial crashes are almost always preceded by rule changes. Not dramatic ones, but subtle shifts that alter incentives, redistribute risk, and delay recognition of stress. These changes are not accidents, nor are they conspiracies. They are responses to pressure inside the system. Banks change the rules when the old rules start revealing problems. To understand why this happens, it is necessary to understand how modern banking systems function. Banks are not vaults holding deposits. They are balance sheet machines. Every asset they hold is matched against liabilities and regulatory requirements. Capital ratios, liquidity thresholds, reserve rules, and accounting standards determine whether a bank appears healthy or stressed. As long as asset values rise and cash flows remain predictable, the system appears stable. But when conditions tighten, rules that once seemed reasonable begin to constrain behavior. At that point, institutions face a choice: absorb losses openly or change the framework that defines those losses. History shows which option is usually chosen. Before the 2008 financial crisis, banks were subject to capital requirements designed to limit risk. These rules were meant to ensure that banks held enough high-quality capital to absorb losses. However, as mortgage-backed securities expanded rapidly, banks found ways to classify increasingly complex and risky assets as low risk under existing frameworks. Ratings agencies assigned high ratings. Models assumed continued housing price growth. Regulators accepted these classifications. The rules did not disappear. They were reinterpreted. When early cracks appeared in mortgage markets, instead of forcing immediate recognition of losses, accounting standards were adjusted. Mark-to-market rules were relaxed. Assets that would have required write-downs were allowed to be valued using internal models. This did not remove the losses. It postponed them. The purpose was not deception in a moral sense. It was stabilization. Sudden recognition of losses would have forced banks to raise capital or sell assets rapidly, accelerating collapse. Changing the rules slowed the process, buying time. But time does not eliminate imbalance. It only reshapes its expression. This pattern is not unique to 2008. In the lead-up to the savings and loan crisis of the 1980s, regulatory forbearance allowed institutions to continue operating despite negative net worth. Interest rate rules were adjusted. Capital definitions were softened. Losses were deferred. The intent was to prevent immediate failure. The result was a larger eventual cost. In Europe's sovereign debt crisis, banks were allowed to treat government bonds as risk-free for capital purposes, even when market prices suggested otherwise. This classification encouraged heavy exposure to sovereign debt and delayed loss recognition. When stress intensified, emergency liquidity facilities were introduced. Collateral standards were widened, and exceptional measures became routine. In each case, rule changes occurred before collapse became obvious. The reason is structural. Banking systems are built on confidence and continuity. Sudden enforcement of rigid rules during stress can cause cascading failures. Regulators and institutions therefore seek flexibility. They adjust definitions, timelines, and thresholds to maintain the appearance of normality. This behavior is rational within the system. It is also revealing. When banks are healthy, rules are rarely discussed. When rules become a topic of frequent revision, it signals that the underlying conditions no longer fit the framework designed to contain them. Another common rule change involves liquidity. Banks are required to hold liquid assets to meet short-term obligations. During stable periods, these requirements seem adequate. But during stress, liquidity evaporates faster than models predict. Assets that were assumed to be easily sold become illiquid. Markets thin out. Prices gap. In response, central banks expand what qualifies as acceptable collateral. Assets once considered risky are temporarily treated as liquid. Emergency lending facilities are introduced. These actions are framed as backstops, not bailouts. Technically, they are correct, but functionally, they alter the rules of access to liquidity. By redefining what counts as liquid, the system avoids immediate seizure. But it also signals that normal liquidity assumptions have failed. Capital rules follow a similar pattern. Capital buffers are meant to absorb losses. Yet during stress, regulators often allow banks to operate below stated capital requirements. Counter-cyclical buffers are released. Stress test assumptions are adjusted. Deadlines are extended. Again, this is not corruption. It is crisis management. But from an analytical perspective, these changes matter. They indicate that losses are larger or more widespread than the system was designed to handle under existing rules. One of the most important but least discussed rule changes involves accounting treatment. Accounting determines when losses are recognized. Delayed recognition can preserve confidence in the short term, but it also obscures reality. Loan forbearance programs, payment holidays, and restructuring allowances all alter the timing of loss recognition. During economic stress, these measures are often expanded. Loans that would normally be classified as non-performing remain classified as performing. This stabilizes balance sheets temporarily. The danger is not that these rules exist, but that they accumulate. Each adjustment reduces transparency slightly. Over time, it becomes difficult to distinguish genuine recovery from deferred stress. Banks do not change rules because they expect immediate collapse. They change rules because the system is entering a zone where old assumptions no longer hold. Rising leverage, asset concentration, maturity mismatches, and interconnected exposures all increase fragility. Rule changes attempt to smooth the transition. The public often interprets these changes as signs of control and competence. In the short term, they often are. Crises are delayed. Markets calm. Confidence returns temporarily. But history shows that systems rarely reset cleanly through rule changes alone. Structural imbalances require either growth that outpaces them or losses that reduce them. When growth is insufficient, losses must eventually be recognized. Rule changes determine when and how that recognition occurs. Another pattern worth noting is timing. Rule changes usually precede visible stress by months or even years. By the time markets crash, many adjustments have already been made. The crash occurs not because rules were changed, but because they were insufficient. This is why crashes often feel sudden to the public. Internally, they are anything but. From a broader perspective, these rule changes reflect the deeper reality of modern finance. Financial systems are no longer purely market-driven. They are hybrid systems where markets operate within policy-defined boundaries. Rules are not fixed constraints. They are adaptive mechanisms. Adaptation, however, has limits. When systems become too complex, too leveraged, or too dependent on continuous intervention, rule changes lose effectiveness. Each adjustment yields diminishing returns. At that stage, confidence depends less on rules and more on belief in the institutions enforcing them. This is the most fragile state a system can enter. It is also why observers who pay attention to rule changes often see trouble before it becomes obvious. They are not predicting crashes. They are observing stress responses. When banks tighten lending standards quietly while publicly expressing confidence, it suggests risk is rising internally. When regulators relax capital rules while emphasizing stability, it suggests buffers are under pressure. When accounting standards are softened while emphasizing transparency, it suggests losses are accumulating. None of this means collapse is inevitable. Systems can stabilize, growth can resume, confidence can return. But rule changes are signals. They tell you where pressure exists, not where headlines point. Understanding this pattern reframes how one interprets financial news. Instead of focusing on market prices alone, one watches the framework surrounding them. The rules define the game. When the game changes, it is because the old version no longer worked. Banks do not change the rules to trick the public. They change them to survive conditions the original rules did not anticipate. The mistake is assuming that survival equals resolution. In the end, crashes are not failures of regulation. They are failures of assumptions. Rules are built on models of behavior, risk, and incentives. When reality diverges too far from those models, rules must adapt. Sometimes they adapt successfully. Sometimes they only delay the inevitable. The key insight is not that rule changes cause crashes, but that they reveal stress before crashes occur. By the time rules are rewritten, pressure has already arrived. And by the time pressure becomes visible to everyone else, the system has been under strain for a long time. That is why banks always change the rules right before crashes. Not because they know the future, but because they are responding to the present, quietly, technically, and long before confidence breaks.